Thank you very much, Jonathan, for that. Mes amis français, ils savent très bien que je suis un grand francophile. Si aujourd'hui je ne parle pas anglais, c'est pour des raisons de protection de l'intégrité et la beauté de la langue française. Moving on then, we come down to the panel. I will introduce them as we go through, I think. We're going to organize it as follows. We're going to try to cover 3 different subjects and allocate about 20 minutes to each one. Those 3 subjects are green bonds is number 1. Number 2 is the question of leveraging private resources using public money. And the third one is the relationship and the role of climate ratings, climate and ratings. So about 20 minutes per topic. Each topic is going to be introduced by 2 of the panel, and then we will chew it up amongst ourselves, the whole panel, for whatever's left of that 20 minutes. I'm encouraging the panelists once again, keep it short, keep it sweet, please, about 5-6 minutes each. I want to kick off, therefore, with the Green Bond session, and our 2 speakers there on my immediate right, Vikas Daura. Vikas works for Yes Bank in India, which is certainly one of the big players, one of the heavy lifters on climate finance in India. He himself has led something like 25 transactions for some $6 billion in this space in recent years. And that's out of a 17-year career. So you can see he didn't do much before he got to that. Vikas. And then after him, Abid Kamali. Anybody who speaks regularly on climate finance knows very well who Abid is. He doesn't really need much of an introduction from me. He's the managing director of climate finance with Bank of America in London. And there's a number of other very important functions in life. What you may not know is that he and I did some carbon finance a few years ago. I think he got the better of it, but anyway. Vikas, why don't you kick off? And what I was hoping that you would start by doing was perhaps tell us a bit more about the rationale for Yes Bank to in the green bond area. Why have you done the issuance, and to what extent do you see, from your perspective, Yes Bank in India, green bonds as really being a useful tool to accelerate the transition? Yeah, sure.
Okay, great. Thank you, Chris. Thank you for having me here. Indeed, we did a green bond issue recently. It's a relatively small green bond, just US dollar 160 million. So that's, if you really take a 70-30 split between debt and equity, enough to fund about 240 megawatt of solar. Compare this to Coal India, which is India's largest coal producer, who's spending $25 billion over the next 4 years to double the coal production. So it's a small effort, but it's significant because it's India's first green bond. And it's a 10-year issue. We did it on a 100 basis point premium to the day's benchmark. We will follow the green bond principles for investing. KPMG is the external assurance agency. It is already listed on the Bombay Stock Exchange, so hopefully we will have retail participation as well. And to that extent, I think it is a fairly significant first step for India. And already we've heard that NTPC, which owns about 50 gigawatt of coal-fired thermal power plants, is planning to do its own corporate green bond to finance 15 gigawatt of solar. So Chris, what we actually achieved, I would say, and hopefully, 4 things. One is we brought green bond into the discussion space within India. Like I mentioned, NTPC is already considering it. The second thing we did was we got investors to look at, investing in renewable energy. These are regular investors who invest in bonds in any case, but they would not have invested in renewable energy in the past. So this would be their first exposure to renewable energy investments, so which again is significant. The third point is, usually, traditionally, bonds are used to refinance. But we are hoping that we can use our own green energy evaluation expertise to make it the first port of call for project financing. And lastly, given that we are a prominent bank within India, I think it sends out a very strong signal that we believe in green energy, and we are willing to put money behind it. We've already financed 2 gigawatt worth of green energy, and we have further, at various forums, said that we will do another gigawatt per annum. So hopefully, some of the larger banks will take notice and put in the extra effort to label their bonds green, develop in-house expertise, and really look at climate mitigation and put money where it really matters. Very quickly, talking about whether green bonds help with transition, I can only speak in the Indian context. Hopefully that is relevant, given the size of the economy, the size of the population, and unfortunately, the growing carbon footprint. We have 260 gigawatt of installed capacity, out of which 165 is coal-fired. Nearly 60 gigawatt is off-grid, and these are all diesel-fired generators. So obviously, we have an issue in India where our demand for power is going to become 3 times the current level in the next 10 years. There is 25% of the country, about 300 million people who don't have access to the grid. So we have to really, really ramp up the installed capacity in India. But hopefully we've learned lessons from other countries. And hopefully part of this will come from renewable energy. I'm sure most of you are aware, but those who are not, I really recommend that you read about what we are planning to do in renewable energy. We have a target of 170 gigawatts of renewable energy till before 2022, which is very, very significant. That will need financing. And in India, renewable energy is usually financed by the banks, which have a floating rate. So for a renewable energy project with fixed costs, fixed tariffs, variable rate becomes a very difficult thing to deal with. Green bonds with a fixed rate, is much more, suitable instrument given the tenure, longer tenure. And it also helps because in India, renewable energy competes with conventional energy for the same pool of money. So if you identify and remove the flexibility and say this money is earmarked for renewable energy, it just helps. And lastly, to conclude, hopefully, while this was a rupee instrument, hopefully in the future we do $1, and that gives the opportunity to the international investment community to really participate in the Indian renewable energy growth story.
Thank you very much, Mika. So something about doing it for Greenfield, something about awareness, something about a demonstration effect, something about the need for scale, given India's challenges, about earmarking and about currency. We'll come back to some of those things. Ladies and gentlemen, your moderator's already made his first error of the day. It must have been the wine at lunch, because the other speaker for this panel for this session was actually Thomas Vellacott. My apologies, Thomas. And Thomas is the head of the World Wildlife Fund in Switzerland. If I read the notes wrongly, he's been doing it since he was 8 years old. Now, either that means that the World Wildlife Fund has been employing child labor, or it means that he's done some other things in between times, and those things do actually include Citibank and McKinsey. But one of the things that they've done recently, World Wildlife Fund now, has produced quite a big report on green bonds, quite a landmark report on green bonds, entitled catchily with "to be green or not to be green." That is the question. It's almost as good as the punchline I heard somebody saying about green bonds earlier this week, 50 Shades of Green. But anyway, Thomas, why don't you talk us a little bit about where you see some of the opportunities and whether you think the market as it stands currently is robust enough, or what changes do you think we need?
Thanks, Chris. And just to put people at ease, when I was 8 years old, I was working as a volunteer for WWF, so there was no child labor involved. Yes, to be green or not to be green. If we look at, just take a step back and look at decarbonization and the sort of transition that this will require for our economies, that is such a huge opportunity that McKinsey once compared it with the industrialization in the 19th century in terms of the scale with which it actually transforms our economies. And I think that's a helpful parallel, because it sort of shows us, if you imagine European economies in 1800 and then in 1900, and how totally transformed those economies were in that century. And I think it's something similar we're talking about here, and it's just important to get that scale of the transition that we're talking about here. And I think that kind of then makes the link to green bonds, because it also shows you the scale of the transition, sort of shows you what the scale of financing will be that's required for this transition. And I think there it's exciting to see instruments like green bonds emerge, but I think that also comes with risks. And with all that opportunity, I think there's three key risks I'd like to refer to here. The first, and maybe that's where the 50 shades of green come in, is that not everything that has a green label on it, obviously, is actually green in terms of what's behind the packaging. And that's something we've seen in a lot of markets as green products have been brought to market. There's been huge enthusiasm, and invariably with all the good products that have been brought to market, there's also been a few which have been rather dodgy, where you've had more greenwashing than greenness in the products. And that's a very dangerous development, because if you have that lack of quality or assured quality, that actually taints all the participants in the market, because market participants then don't know what the different quality, what the quality of the offerings are. And I think in green bonds, there's a risk that that could happen as well. So again, in analogy to other markets, whether it's carbon, whether it's commodities, it will be important to have credible standards, credible criteria. And credible in our experience, and we've been part of numerous roundtables working on standards, key are two things. One is to do it in a multi-stakeholder fashion. If you get industry certifying industry or setting standards for industry, that doesn't normally add to the credibility of a standard. So you want to get in lots of different players from different segments to really make sure that you develop a robust and credible standard. And the second thing about quality is then, of course, to have independent verification, third-party verification. And I think we heard about the green bond principles. I think that's a great step forward. I think it's not actually what we mean by criteria. Criteria go further than that. It's the basis, the principles, but then you need to go beyond that and be very, very specific what criteria to apply. So I think there's that first risk or challenge, which is all around ensuring the quality and the greenness and avoiding the greenwashing. The second risk or challenge I see relates to the scale. And I love the subject of the conference here about the shifting the trillions. And I think it's important, again, to have the scale of the transformation that we're talking about here and be aware of that. And we're not obviously shifting the trillions yet. And despite all the dynamics in the green bond market, I'm not sure if the green bond market will shift the trillions. So there needs to be a lot more. So there needs to be a mainstreaming, and we need to avoid that the green bond market remains a niche, but rather think about how environmental and social criteria can be applied across the board, both in the bond market and in other segments of the financial sector. So I think that's a huge second challenge there, which is how can we move beyond the niche? And again, it's a challenge which we've seen in lots of different sectors before, where you've had companies moving really to starting first with a small portfolio of green products and then really mainstreaming principles into their entire supply chains. IKEA, to mention just one example, has moved to a goal of 100% sustainable forest products in their supply chain, 100% sustainably sourced cotton, 100% sustainably sourced fish, et cetera, et cetera, et cetera. So really transforming the entire business model. And the third challenge, or risk or opportunity, depending on which side you look at it from, I think is the question of who is actually going to be providing the investments the finance behind this transformation of decarbonization. And again, it's interesting to look back to the Industrial Revolution of the 18th and 19th century, and to see that the banks at the outset of that process were actually not, on the whole, the institutions that provided the finance for the infrastructure investments in the industrialization. Very often it was entrepreneurs going out and setting up their own institutions because the existing incumbents were either unwilling or incapable to finance the needs for those investments in industrialization. And what you saw at the end of the process was a financial sector that looked very, very different from where it went in, with very different players. You had banks that were very big at the outset have become total niche players, and other institutions like Credit Suisse or Swiss Re had emerged into global players. So I think here again, the question is, will incumbents be able to transform their business models fast enough to provide the sort of finance that is needed for this transition, or will it be new players coming in and providing the finance necessary? So I think those are sort of the three risks which also at the same time provide you with, I think, some of the way forward, which is, one, to ensure that we really have credible standards in when we finance this transition to clean infrastructure. The second is that we move beyond the niche and ensure in our institutions that we bring these principles out of niche products and into the broad market. And the third is that the willing players, both incumbents and newcomers, join forces together, because this is really a generational project where we need all the willing parties to pull together and get this done. Thank you.
Thank you, Thomas. And from an interesting political, historical perspective about integrity, credibility, about outing the standards, getting them into the mainstream, away from the niches, and something about incumbents versus new players. Good, thank you. Abid, having whetted your appetite earlier, let me now turn to you. Hand on heart, a lot of talk about green bonds. You've just heard some of the doubts. Do you think they really are leading to, or will really lead to new low carbon investments? Is that the case, for example, of the announcement that your boss made this morning, another 600 million, I think it was? And maybe while you're at it, why don't you talk a little bit about the financial performance of those green bonds which are out there, because at the end of the day, that's going to drive the appetite.
Thanks very much, Chris. And that's quite the collection of issues to comment on. But if I could first address something, Thomas, which you addressed, and that is the question of principles, the green bond principles. And from a financial market participant's perspective, I would say, when our bankers helped develop the principles, it was a situation where there was no unanimity around, and I don't think there is still any unanimity around what constitutes green. It, as Chris, and I think, Chris, you stole my punchline, it was, not just 50 shades of green, but perhaps even 1,000 shades of green. And I'm not saying it's unimportant, but I think there's a lot of capital that needs to be shifted in a hurry. So let's begin with something that's not perfect. Let's engage with the investors. And from my perspective, let's engage with our hundreds of debt capital market salesmen and women who have a job to do. They have to engage with their clients to assess and try and grow this market. So that would be my comment on that risk, but I hear what your main point was. Now, in terms of, is this genuinely leading to new investment? Let me give you some data on that. The largest green bond this year was a green bond for the YieldCo subsidiary of SunEdison, known as TerraForm. $800 million, a 5.8% coupon, and an 8-year tenor. So I guess I should explain, a YieldCo is a listed vehicle, so it's an equity vehicle, for essentially bundling cash flows coming from existing and new renewable energy assets. So the reason they went to a green bond is that they wanted to, they've committed to really grow the portfolio. Once you commit to a yield co, you're basically saying we need to provide investors with a steady coupon over a significant length of time. So we know from that data point that that's leading to new investment. We also know when we look at the various tenors of the green bonds that have been issued to date, that the longer the tenor, generally, the more you can say that there's new investment as opposed to simply refinancing, although I'm not an expert in short-term treasury management. And interestingly there, we see 18% of the tenors of issued green bonds are now more than 10 years. That is a significant step change. And then the third data point I would point to is, and this comes, Chris, from our own experience, in fact, with our second benchmark green bond issued last week, you can actually specify, you can say, we intend to allocate X% of this bond's proceeds to refinancing, and Y% to new finance. And that's exactly what we did. It was a key criteria for us to demonstrate that we're trying to deploy capital towards new renewable energy, new energy efficiency, and investors responded. The second bond was more than 2 times oversubscribed. Our treasury was very happy because, of course, we diversified the investor base even further, and that's a key part of green bonds. It's the engagement with the investor community. Now, if I can wrap with the last question you had about performance. So to help grow the market further, my colleagues launched in 2014 a green bond index, and we now have lots of data about the green bond index. What's great about the index is that we see, for example, that when you look at average total return divided by the volatility of those returns, that green bond index is outperforming every other bond index out there. Every other bond index out there. Corporate bond index, investment grade, high yield corporate index, investment grade government index, and broader bond indices. So that, I think, speaks to the performance of green bonds.
Thank you. So some pragmatism and some real performance. And as you say, even those of you who might be in the front line of the accusations about integrity, you're walking the talk. Okay, good. Because you touched on something at the end there. We haven't got a huge amount of time for this topic, but I think it was an important point you just dropped in at the end of your introduction. There was currency and internationalizing some of these flows. Do you want to sort of try and talk a little bit to that point, how you see that challenge being dealt with? Give you a couple of minutes.
Sure. So green bonds are, the problems they face are similar to what any other bond, would face. And for an international investor investing in Indian bond, the biggest risk they would face is the currency risk. And, Chris, the Indian rupee may have depreciated maybe 3% over the last, every year over the last 25 years, but obviously there are spikes. And hedging is very, very expensive. So that kind of takes the math away from being a viable option for a lot of investors. So in the past, whenever we've spoken to international investors, currency risk keeps coming up again and again as a major risk, even if they get comfortable with the investment grade of some of the projects we are showing. So there are 2 things which the government of India has been discussing. One is to actually do some pilot solar projects with dollar-denominated PPAs. That would take the risk away from the investor, and it would actually put it on the government. But in the long term, they're reckoning that if you are saving on importing fossil fuel, then perhaps it pays for itself. The second point that they are considering is to probably have a concessional rate window where developers would have an opportunity to have a concessional exchange rate. And this indeed was done for some of the oil companies in India which import crude oil. When there was a sudden spike, there was a special window created for them. So there is some past history to this. But to conclude, Chris, I mean, this is one challenge which we really face because the returns are not very different from international returns on the project, but there is an increased cost of hedging.
One very last question on this one. I'd like to bring Mike Wilkins in here, if I may. Mike, you're the man who rates the bonds. What's your prognosis? Do you see this? Do you see growth? Well, we had big growth, but do you see it carrying on at whatever exponential rate it was last year?
Yes, I mean, we see quite strong growth in the green bond market. We've been tracking the corporate green bond market, especially over the past couple of years, and it's grown phenomenally. This year, we expect there to be somewhere in the region of about $30 billion of issuance of corporate green bonds, which is phenomenal given where it started from a couple of years ago, which was virtually zero. But we have to bear in mind in this debate that $30 billion is a drop in the ocean in terms of the total amount of fixed income instruments out there in circulation, which is somewhere in the region of $90 to $100 trillion. So we're far away still from the scale required to tackle climate change, and that's the key issue here: how to scale up. And Chris, you mentioned that earlier. And I think that will happen once the market evolves further. I think it's made a great start, but it needs a further evolution. At the moment, most of the green bonds that we've seen issued are green labeled bonds. So the credit quality that backs those bonds is the credit quality of the issuing entity. That gives investors comfort on the credit, but it in many respects hampers the growth because there's only a finite number of assets that can be refinanced using green bonds. What we really want to see is additionality. We want to see the green bond market grow to the extent that there's finance raised for additional investments in the low carbon economy. And we believe that will come. It will come once we evolve the market away from green labeling to more risk transfer. In other words, things like green project bonds, where the cash flow of the assets being financed back the credit quality of the bonds. That will lead to increased risk for the investor, but commensurately, that will also lead to increased yield. And out there are many investors looking for yield at the moment in the current low yield environment. And the other thing I'd just like to add on this debate is the question of additionality. We need to see the assets being financed for extra investment, but we also need to see green bonds emerge away from just mitigation, but also to adaptation. Would a bond issued for building flood defenses be classified as green or not? And that's one of the key questions, because as much money is needed for adaptation as is needed for mitigation.
Thanks, Mike. That's all good stuff. Let's move on then to the second topic, if we may, which was, I remind you, using public resources to leverage the private resources. And at this point, let me bring in Andreas Neukirch. Andreas is, I hope you won't mind my describing him thus, as a social entrepreneur. He's on the main board of GLS Bank and is chief financial officer there. GLS is a small German mutual bank based in Bochum, beautiful town on the Rhine. So he has a good quality of life, I know that. But they specialize basically in social and ecologically oriented finance, probably also describable as impact financing. I came across Andreas recently because his bank placed some fixed income notes for a fund which, as it happens, EIB has been a sponsor of, a thing called the Green for Growth Fund. By any other name, this would be a green bond. On a very small scale, but a very significant scale. So, Andreas, perhaps you'd sort of tell us a little bit about how that worked, and maybe, if you would, take 2 minutes and describe the sort of layered structure of the fund, because it's a beautiful illustration of how one can take some public capital and leverage private capital, such as the money that you raised and placed for the fund.
Thank you for the invitation. And it is for me a very interesting meeting today, because as someone who is coming from the niche and started with social and ecological investments at a time where the word green banking wasn't well known, it is very, very important to get this feeling that everything what we did in the past now is more able to scale up and find more and more investments. That's very important. As we offered this Green for Growth Fund for our customers, We expected on one hand that they were very interesting in this investment on one hand, but on the other hand we were a little bit surprised because of these huge demand of our customers. Therefore you have to know that we are a bank which was founded from people from the civil society in the early 70s last century, and these people were very engaged to deal with their needs, not waiting for the support of the public sector. So they were very, very engaged to find their own solutions, to look for their own goals, and to be initiative. And the Green for Growth Fund is, on the other hand, a fund which is enabling the investments of the private sector and the investments of the public sector. But on the other hand, we saw immediately that many of the goals of this Green for Growth Fund are totally meeting the goals of the GLS Bank, especially to combine these responsibility of a customer for their own investment, and to make it with a very concrete focus, for example, a regional focus on special goals for reducing climate consumption, and so on. And that was really the reason why our customers are dealing with this. And we can say that this structure of Green for Growth Fund is interesting for the private investors, because we have 4 different kinds of investments. On one hand, these notes for private investors, on the other hand, an A-share for public institutions or development banks, a B-share like a mezzanine capital, and a C-share which is sold by the BMZ, the Ministry of Economic Cooperation. And this combination was always interesting for our customers, because they get something like a special impulse that they not only have the need to invest in their city in Germany or so on, they were enabled to invest in the South and Eastern Europe, and that was nothing what we can do with our own instruments. So we were very happy to have these combination of public and private investments.
Great. Well, I think that's a very nice living example, personally, of public-private cooperation, which, for those who like the numbers, is generating around $6 to $8 of investment on the ground for every dollar of taxpayers' money which has gone in from the German government, and, if I'm allowed to mention it, from the European Commission as well. Abid, you were also slated to introduce this one, if I may turn to you, and maybe perhaps put your hat on as the private sector representative in the Green Climate Fund for this, which is clearly going to, I think, have an important role to play in these kinds of structures going forwards.
Yeah, so I think the Green Climate Fund is, in a way, a perfect example of needing to take the lessons of blending public and private finance to a new level, because it's the main financial vehicle through the UN negotiations. It'll be a key part of the COP21 deal. And we need to demonstrate that the Green Climate Fund, particularly the private sector facility part of the Green Climate Fund, can blend the risk mitigation of public capital with the scale of private capital. And that's how we'll achieve the leveraging that you've just spoken about, Andreas. You know, if we could get, for the Green Climate Fund, that sort of 6-to-1, 8-to-1 outcome, that would be a tremendous achievement. So in simple terms, when we think about what the Green Climate Fund could be doing, to keep it brief, I'll say it needs to be reducing risks, lowering the cost of capital, or in cases when we're talking about base of the pyramid energy access type opportunities, providing seed capital upfront. And really, all of the types of interventions that we're talking, that, that are possible for the Green Climate Fund should demonstrate that they're accomplishing one of those three objectives. And then the performance metrics are also important. They need to bend the trajectory of emissions, so clear CO2 performance. They need to mobilize private capital, and they need to contribute to other sustainable development goals.
Good. That's a very clear answer, and you're creating some high expectations there. Thomas, let me turn to you, if I may, on this one again. Your organization has called for some tightening up of the rules, as it were, and the definitions relating to climate finance. What would you think the governments should look out for when they are trying to incentivize or use their own scarce resources to incentivize the private sector to finance low carbon?
I just wanted to very briefly come back to something you said before, if I may, about the green bond principles. I did not want my statement to come across as a criticism of the green bond principles at all, because we're engaging with them as well, and I think it's a tremendous initiative. I think it was more about going forward. It needs to be developed into more of a multi-stakeholder thing and involving a broader platform. But the idea of going forward and not waiting, I think, is exactly the way to go in this. So government's role here, I think it was already referred to in terms of ensuring that there's a real impact there. I think that's one of the key things here. So really having an impact lens there to make sure something's not just labeled green, but is actually truly providing transformation in terms of impact. And I think, clearly government's role goes much further than being part of providing capital, which it should be doing. But I think there's also things in regulation which call for government action there, obviously. And if I take again infrastructure investment as something very long term, and on the other hand, when you then look at how capital charges are levied on long-term investments, there's basically a penalty for going long-term, which I think is actually inhibiting a lot of the investments that we could be seeing in sort of sustainable infrastructure. So I think there's issues there around capital charges and things like that, where governments can come in and play an active role in addition to this sort of teaming up with private capital providers in the way we've just heard.
Vikas, a quick question for you, if I may. You've already talked about the enormous gap, the financing gap in the Indian program, 300 billion of renewable energy projects to come, and clearly not. The capacity within the Indian financial system probably to meet that. Has the Indian government got any plans to use whatever public resources it can throw at the problem in similar sorts of ways, with a view to leveraging more out of the private sector?
Yeah, Chris, to achieve the plan of 170 gigawatts of renewable energy by 2022, we need about $200 billion approximately, which also includes upgrading the grid, making it a smarter grid, more modern, more resilient, and more efficient. As of today, most of the renewable energy projects are private sector projects. And the government certainly is taking steps to create the right atmosphere for private and public sector money to flow in together. And there are a few instances which I can talk about. One is just to demonstrate the government's will. For the first time in India, the individual responsible, who is the union minister for conventional energy, is also the minister responsible for renewable energy. So for the first time, there is no conflict, and there is one individual who can balance both needs of conventional as well as renewable energy, which is actually a very, very positive move, because it's just helping things move along much, much faster. The second is the government is actually nudging the public sector enterprises, which happen to be the largest producers of fossil fuel, like Coal India, oil and natural gas, NTPC, which is a large thermal power owner. They are nudging them to invest in renewable energy. in gigawatts. So NTPC, like I mentioned, 15 gigawatts in solar. They've all been given a target to sort of achieve. So this brings public sector money into renewable energy. And there is a concept of DCR, which is domestic content requirement. So these companies need to buy the solar modules and panels from Indian manufacturers. So this kickstarts investment in the entire value chain. So it's not just the final project, but also the entire value chain where you get investments. Then the government is also doing things like setting up a solar park, making it very easy for overseas investors to practically come and plug and play. So the land is taken care of, there's basic infrastructure, evacuation, transmission is already taken care of. So it could have a capacity of 1 gigawatt. You could come in, have a plug and play of 100 megawatts. So this again, the government is providing public money to really encourage private capital to come. And then there are some software aspects as well. The government has directed the banks to really treat rooftop solar as part of the home loan. So in case you're interested in putting up a solar rooftop panel, you can just treat it as part of your home loan. It just makes it so much more affordable. So these are some of the things that the government has done, and in our opinion, these are things which should really encourage private capital to follow.
Interesting. So Indian government walking the PPP talk as well. Very good. Mike, you've got a broader view of infrastructure, not just the low carbon stuff, but some of the shall we call it high carbon stuff. And I know that you've got a good sense of the sort of public sector, public budget's willingness to get involved in this kind of expenditure, to support this kind of expenditure, and also to get involved in some of these structured transactions, which the intended outcome is to mobilize from the private sector. What's your sense of the real appetite of public sector financiers to put more money into these kinds of leveraged structures? And how successful have they been, by the way?
The problems being faced by the green finance world are no different to the world problems being faced by the infrastructure finance world, and that essentially is that there is a funding deficit as opposed to a financing surplus. The funding deficit essentially means that the public sector, whether it's governments at the state or local level, are not willing to put their funds towards the procurement of projects, whether they're green projects or other. It's still the same. They're not willing to put their funding towards those projects and procure those projects because fundamentally they either can't afford it because of austerity, because of budget deficits, or essentially they don't buy in to the benefits that that investment will create. And that's a perennial problem, but it's a problem which has really been exacerbated over the past few years since the financial crisis. We've done a number of studies in terms of looking at the financing gap in the general infrastructure world. We estimate it to be around $500 billion per annum between now and 2030. And that's really a result of a diminishing proportion of GDP spent on infrastructure by governments. And in relation to the infrastructure requirement, which is somewhere in the region of $57 trillion between now and 2030. So there is that funding gap that needs to be filled. We've said that that funding gap could be filled in terms of the banks, in the multilateral institutions, and also the institutional investors, which have decided to allocate more of their assets under management to the infrastructure space, increasing the average allocation from 2 to around 4%. So there is a solution to this problem, but for that to happen, the institutional investors need to be incentivized, and we already heard about the capital adequacy rules being a disincentive. On the positive side to all this, we've seen the Commission, the EIB and others come up with plans such as the European Investment Plan, whereby it intends to provide seed capital, risk capital, multiply it up by 15 times. These kind of incentivization initiatives will help, we believe, although they seem to be very ambitious given the 3-year time frame, but the mobilization of 315 billion euros in 3 years will go a long way to help solve the issue. But one thing I would like to just conclude this point on is we've seen the multiplier effect being quite clear in terms of infrastructure investment. For every 1% of GDP you spend on infrastructure, you get up to around 2.5% in terms of return, in terms of job creation and GDP growth. What is the green multiplier effect? Is it also related to GDP growth, but also what about the incentives to benefit for the environment? That's got to be looked at as well, the green multiplier effect.
Thanks. You kindly mentioned EIB. We always like a plug. Thank you for that, Mike. Jonathan, is there anything more you'd want to say about EIB's efforts in terms of promoting these structures? You gave one example of GREF. You've had another one mentioned in the panel.
Well, I did, and those are two good examples, so I don't think I'll give any further examples along those lines, although there are plenty of others around. I mean, I think I just make the more general point, of course, that the mission, if you like, the mandate for multilateral institutions and indeed regional institutions and other institutions, national institutions like this, is that they should be co-financing. And so they start from the proposition that they are co-financing something. The idea is that in our case, we never finance more than 50%. It's usually actually around about 30%. So we're starting off with the sort of clear mindset that we are going to be leveraging in private finance. We, at least in our case, again, we have, and others have this too, you know, we go through extensive due diligence, which isn't just, if I can put it this way, sort of financial due diligence. That, of course, has to be passed, because at the end of the day, we're all institutions who have to pay back the money which we've borrowed in the first place to on-lend. But we also are engaging in our case, you know, economic studies, engineering studies, environmental studies, and so on, to ensure that the projects which we are financing are good ones and are going to be achieving those objectives. And the private sector counterparts who are co-financing take comfort from that. And that is a way of helping to leverage the money in. So I just mentioned that point as well.
I think those are all good points. Okay, the time is moving on, so I need to take us on to the third topic, if you allow me. I realize that I was rude to Mike. I never formally introduced him as well. Mike, many of you will know him already, by the way. He's another regular speaker on these events, and he's a managing director in Standard & Poor's, who, with a special responsibility for a large area of infrastructure and utilities, and is pioneering a lot of the research that Standard & Poor's have been doing on the impact of climate change on the ratings industry. So, Mike, your bread and butter business, obviously, ratings. We've heard a lot of discussion this week, not so much today, but in other forums we've had a lot of discussion about stranded assets. Is this having an impact on ratings and valuations, and to what extent do you really think ratings are going to, in the future, be driven to a greater degree than is currently the case by climate risk, climate event risk, as well as climate compliance risk, to the extent the regulators start putting some bite on that?
Thank you, Chris. I think first thing I wanted to say was that Standard & Poor's takes climate risk and climate finance very seriously indeed. If anybody's any doubt about that, you should look at our recent publication assessing the potential long-term impact of climate change on credit. We've been looking at the topic of climate risk and its impact on ratings for the past 10 years in quite considerable depth. We've looked at the risk of carbon liabilities, we've looked at the risk of stranded assets, and we're now starting to look at, in quite to a considerable degree, into the issue of extreme weather events and the impact it has on corporate resilience. So there is a whole package of research that we've put out on this topic. The question now is, how does that research inform us, and more importantly, inform investors on how best to assess the impact of climate on their credit instruments, whether they're bonds or loans. Just to mention a few things on that front. Essentially, when we look at the impact of climate change, it starts off from the point of view of the policy impact and being part of a compliance regime, and the direct liabilities that a company may face as a result of that. And back in the sort of period 2009 to 2012, the cost of carbon, which was at that time expected to be up to 30 or 35 euros a ton in Europe, had a considerable impact, leading to downgrades of some companies which are exposed to fossil fuel. So that's just an example that, you know, there can be a direct correlation between credit quality and climate risk from a policy side. More recently, we've done research into the whole issue of carbon constraints. If we move towards a 2-degree scenario, what would that do in terms of the impact on fossil fuel companies? Back in 2013, collaborating with Carbon Tracker, we forecasted that a 2-degree scenario policy shift would lead to a decline in the demand for fossil fuel, oil and gas especially, and a precipitous fall in the price of the oil price down to around $65 a barrel. In fact, we've seen that happen by now. This was predicted in 2013 to happen by 2017. It happened in advance of that. Admittedly, not just for climate policies, but we believe that's part of the reason. Now, we identified at that time which companies would be most exposed, essentially the non-conventional, undiversified companies like Canadian Oil Sands, which were already highly indebted, single B at best. In those kind of situations, if you've got the double whammy of a fossil fuel carbon constraint and also high leverage, you're going to force increased credit and default risk. That's already been identified. Now, if we move to the issue of climate resilience, which I think is one of the main things that we need to look at, we are part of a 1 in 100 initiative. Basically, this is a stress testing issue which has already been implemented across the insurance sector and is now being transferred across to the corporate sector. How can companies cope with 1 in 100-year extreme weather events? Have they got the balance sheet strength to withstand that? And if so, how? That's something that needs to be disclosed. That's something that needs to be made transparent to investors so they can make informed decisions. And just finally, Chris, in terms of how we intend to go forward with all this, you know, we've been focusing essentially on the materiality of climate risk. Just how much is it going to cost companies? How much is it going to hit their cash flow? Essentially, that's because that's the key metric for us in terms of ratings. So now that we've got a better handle on the materiality of climate risk, we now need to focus, or have been focusing, on the time horizon. Our ratings focus mainly on the 3 to 5 year horizon. Many people know that the climate risk is a much longer term risk. But nonetheless, as we've shown by our research on stranded assets, this can actually come to roost a lot sooner than sort of 5 to 50 years, which is the long term. So we need to take that into account. We're working on that. We're looking at the best way to incorporate this risk and materiality and the time horizon to make sure that our assessment of credit risk properly factors in climate change.
Great. So I think there was 3 yeses. Yes, it's there. Yes, it's material. And yes, we need to be doing it now. Yeah, and it's okay. Good. Abid, I was also going to count on you to do some framing of this issue, if I may. And if I gave you 5 minutes, could you talk us through the maths of carbon bubbles?
Well, it's difficult to top what Anthony Hobley did this morning on the panel, but look, let me tell you why I think this is becoming an important issue. And Chris, I hope you're not asking me this because I narrowly avoided becoming a stranded asset myself as the former head of the carbon market business within the bank. But look, it's the math is you've got the 3 yeses and you've got 4 individuals who I think are doing marvelous things in this space. And I mentioned Anthony, you've got Mark Carney, you've got Bill McKibben, and you've got Henri de Castries, the newly recruited member of the band. So each of those individuals, you've got regulators through Carney, you've got the divestment movement through Bill McKibben, you've got the think tank, financial analysts with Anthony, and now you have an investor that's moving. It's a very interesting cocktail that's suggesting this is becoming very, very topical. The maths, look, it's 2 degrees, 550 ppm, 500 gigatons of carbon, and therefore that leads to some quantity of coal, oil, and gas that probably can't be burnt. Can I translate it into financial insights? Because I think that's more relevant. So if I can summarize what I think are the 5 things the financial markets are now contemplating. Is there a question about equity valuation if some of these reserves can't be burnt? Do we need to focus on the high-cost reserves subcritical coal, the oil sands, as a couple of examples. Given the changes in the markets, given the changes in climate policy, given technological innovation, it could be multiple things that lead to stranded assets. The third insight would be, is there some quantum of capital that is perhaps not being deployed in the optimum way? And should there be a focus on the high-cost, high-carbon energy projects that may no longer be profitable? Then the fourth one is really about risk premiums. Every equity analyst worth his or her salt will have their own sense about risk premiums. And I think this is now becoming a broader discussion. And then the fifth one is presumably the reason why Mark Carney has got engaged, and the UNEP inquiry is looking at this, because there is a question about what's the impact on market stability.
Andreas, let me put you on the spot on this one, because I'm guessing your membership, in a very far-sighted way, when they made their bid for self-sufficiency in the 70s and the 80s and decided that they weren't going to be caught up in some of the kind of more mainstream dependencies, as it were. Part of that must have been because they had some sense of that assets, economic assets, were going to become obsolete, we're going to become stranded. Is that still an active consideration in your bank, given that you already have these quite strong value-based priorities in your business activity?
Yeah, that is one reason for the development, that we have these value-based business model. But everything what we talked about today is the need that all these activities are growing up more and more and faster. And so, for example, in Germany, we have only 200,000 customers, which are related with our business model. But on the other hand, there was a study in 2010 that in Germany were more about 15 million people which were interested to give their money in these social and ecological oriented projects. And that is what makes us very optimistic, because of two reasons. On one hand, it is good for our growth rate, because more and more customers are joining our business model. But on the other hand, many competitors in the German finance markets are interested to promote such projects and investments. And that will lead us to a totally new level of markets and a totally new level of acceptance of all these things. Of course, I think that will not happen during 1 or 2 years, but the basics are very, very good, and the people were more and more aware of all these possibilities. And that is what makes us happy. Everything what we see from partners in the financial markets is that they strengthen their offers, they strengthen their support for these investments. And I hope more and more financial instruments were based on values and based on really significant goals, and not, like you mentioned, only greenwashed, but really green in the core of the business. And then we are on the right way, I think.
Okay, very good. Jonathan, you already talked about the due diligence processes in EIB, and are they, in your view, a sort of sufficient? Does EIB sufficiently address the risk of carbon stranding through that process, or could a bank with a portfolio of $600 billion be doing more? Should it be doing more?
I am sure we could be doing things better. We do things, I think we do things, happen to think we do things very well. I happen to think we do them very thoroughly. I think we do those processes very thoroughly, and maybe I should at this point put in a plug, which if anybody wants to read the standards and so on which we use for this purpose, they are all readily available on our website, and I do urge people to look at them, because they are thorough and comprehensive. But I'm sure we can do better. Yes, is the short answer to your question. Even though I think that, even though I'm very pleased and proud about what we're doing.
Thomas.
The whole development of standards and applying these standards across the board, I think, is a hugely important one here. And I think we're seeing some interesting developments there. You mentioned before the standards you apply in EIB and those de facto leading to no investment in unabated coal. And I think there we're seeing a strong dynamic, which is very exciting, but which has yet to reach a lot of the private sector. So I think there's a growing understanding that this issue of stranded assets has sort of woken up a lot of people who I think up to then had really looked at carbon risks more as a sort of, well, there's maybe a reputational risk there if we're involved, and a realization that it's a real business risk. But that hasn't been translated yet into standards like we heard about in the case of EIB. So I think there's a lot of homework there still to be done. And it's interesting also how different regulators play on that. The Chinese banking regulator, the CBRC, published 3 years ago green lending criteria, green lending guidelines for the Chinese banking sector. Now, these were nothing about a small niche, but this was about ensuring that these sort of risks are really taken into account in any decision that Chinese banks take when it comes to lending. Of course, this takes time to implement, but I thought that was an interesting fact that China went ahead there. And something you said, Mike, earlier I thought was also interesting in that context, that this can hit us much faster than we initially thought. And I think what we're seeing at the moment with coal use in China, for example, declining for the first time, these are the sort of developments where I think we're realizing that these shifts can happen a lot quicker than we thought, and I think some people will be caught unaware of that.
I think we're coming up to the last few minutes, so I will, starting with Mike, because I know he particularly wants to get out of here punctually, give everybody kind of 1 minute at the end. Before going there, I just want, as you mentioned, private sector and their responsiveness, Vikas, India, domestic institutional investors, how much are they getting this risk, this carbon stranding risk? Is it an active part of their discussion these days?
It's certainly an active part of risk assessment. It's certainly an active part of discussions which go on in the boardrooms, within the banks. And there is certainly a conscious effort to look at various options and, what are the kind of end usage your money is going to. But you need to realize one fact that in India, we have huge linkage issues which are currently there. We have 7 gigawatt of brand new super ultra critical thermal power plants which are up and ready, but there's no coal for them. So while these discussions are ongoing, there is also a intensive effort to get the coal and the other fossil fuel, going, the production going. And it is a little bit contradictory, both things, but I think the balance is what is important.
Okay, well, that's a somewhat ambiguous note to finish on, I guess, but it's probably the realistic note. So I think if, offer the opportunity, final comment from anybody who would like it. Jonathan, 1 minute.
Well, very, very quickly, I mean, I'm by nature an optimist, and I'm optimistic about the progress which we're making, which I think is, compared to where we were a few years ago, is very, very considerable indeed. You can see there's a but coming. The but is that there's plainly a lot more which we can do, and we've been talking about some of the things here which we can do, some of the concrete actions we can take, and I think we need to carry on working on that. And I look forward to a successful outcome at the end of the year. Thank you.
Mike, you go, and then if you want to leave the stage to catch your train, feel free. You'll miss the clap, but apart from that.
Thanks, Chris. Yeah, I would just echo that. I think this is a pivotal year, not just because of COP21 in Paris at the end of the year, which obviously is going to be very important, but that there are other initiatives which are happening this year, which basically are being spurred on by the COP. One of the important ones is the conclusion of the UNEP inquiry into the development of a sustainable financial system. Such a mouthful, that one, but anyway, it's very, very important, because I think you need something radical like a redesign of the whole financial system for sustainable growth to actually happen. And I think the UNEP inquiry is going to be absolutely pivotal in that. So we're very pleased at S&P to be involved in the UNEP inquiry, and I really look forward to that coming to its conclusion in, I think it's October this year.
Maybe just to echo two thoughts there, I think this is a really interesting moment we're in at the moment, this year. And one is because, as we've been hearing, mainstream institutions are really starting to get interested in these topics in a serious way, not just as a little niche. And I think what you just said, Mike, the need, sort of the scale of transformation also within the financial sector that is needed to address this broader societal and economic transformation. I think we're starting to realize what that means. And I think we're starting to see a sort of segmentation between players who get how fundamental this shift is going to be and are starting to explore that, and others that are stuck in 20th century business models and where it's very hard to see how they're going to make this shift. And so this really is a crucial moment. And for me, I am absolutely convinced that we can make the transition to a 2-degree future. The question is, can we move fast enough? So it's an issue of speed. And I think this is really the opportunity for all of us to make sure that we move at speed, at the speed required to make this transformation.
Thank you. The fact that Benoit is standing there means we've got about 3 minutes, I think. So it's literally a minute each, gentlemen. Andreas?
I only like to mention that the use of changing business models in this year and the next 2 years will enable us to bring these green focus much more on a higher level, and that will lead us to good investments in the future.
2 quick points. We have to be realistic about how fast change is possible. 75% of the global power sector is fossil fuel. 95% of the transport sector is fossil fuel. That's the first point. And the second point is, if we think about the signal that investors could get from the important meeting at the end of the year, it's probably, will there be some quantified target on net zero decarbonization? The draft text points to potentially 2050, but it may be nixed completely.
So what comes across to me, coming from India, is that we have a huge social responsibility to our own people, but as part of the globe, as a global citizen, we also have a responsibility to be part of climate, mitigation, climate change mitigation, and hopefully the policymakers in India and the private sector can come together and find a point of balance where we can have growth without sacrificing, basic principles of climate control.